Hey everyone, welcome back to Corporate Decoder, the place where we decode the deepest corporate secrets while the CEO takes a smoke break. A huge SPAC IPO is dropping, and it's from a company with a super familiar name in finance, Cantor. Get ready for this one because Cantor Equity Partners V is going public, and we're diving deep into their S1 filing to see what's really going on behind the scenes. Normally these filings are drier than a desert bone, but stick with me because we're uncovering the risks, the strategy, and especially the vital numbers that tell us if this public offering is a winner or a total flop. Alright, so Cantor Equity Partners V is basically a blank check company. Think of it as a startup that's been given a pile of cash from investors and its only job is to go find a real operating business to buy or merge with within a set time frame, usually 2 years. If they don't find a business, they have to give the money back to the investors. They're planning to sell 20 million of their Class A shares for $10 each, which would bring in a massive $200 million. Plus, the underwriters have an option to buy another 3 million shares if things go well. Now, here's where it gets interesting. Their sponsor, which is an affiliate of Cantor Fitzgerald, basically bought founder shares for practically nothing. This means that right off the bat, the investors buying shares in this IPO will experience significant dilution. It's like buying a piece of a company, but a big chunky piece was already given away to someone else for pennies. This whole founder shares situation is a big deal. It means the sponsor could make a ton of money even if the company they eventually buy doesn't do all that well and the share price drops. That's a potential conflict of interest because the sponsor might be more focused on making their own profit than ensuring a great outcome for the public shareholders. It's a bit of a gamble for new investors. Let's look at the cash. The sponsor bought over 5 million Class B shares for just $25,000. That's less than half a cent per share. Meanwhile, the public is paying $10 per share. If the company makes a business combination and the shares are valued at the IPO price, the sponsor's initial investment could jump from $25,000 to over $57 million. That's a massive jump, and it's important to understand this incentive structure. Like all SPACs, they have a ticking clock. They have 24 months to find a business to buy. If they don't, they have to give the money back. And that's a very real possibility with so many SPACs out there and the market conditions. This means your $10 investment could end up being a $10 return if they liquidate. And if there are any claims against the company, it could even be less. And speaking of claims, remember that $200 million in the trust account is not some magic money safeguarded from everyone. Creditors could potentially get their hands on that money if the company runs into trouble. So the $10 per share redemption isn't a guaranteed safety net. Now let's talk about what your shares are actually worth on paper right now. After all the IPO dust settles and considering different redemption scenarios, the pro forma net tangible book value per share could range from as low as a negative $1.26 to a positive $11.34 depending on how many people cash out. And if the underwriters sell all their extra shares, that negative number there in the maximum redemption scenario is a bit alarming and really shows the dilution effect we talked about earlier. Looking at their actual operations up to June 2025, while there's not much to see, they've spent about $214 on general and administrative expenses in 3 months ending June 2025. That's incredibly low and expected for a company that hasn't even found its target business yet. For the full year 2024, they spent about $7,000 on these expenses. It's pretty much all setup costs, and they've got about $1,436 in deferred offering costs on their balance sheet. The whole operation, company sponsor and underwriter are all tied to Cantor Fitzgerald. This means there's a significant concentration of control and potential conflicts of interest, which they clearly state. They're aware that other Cantor affiliated SPACs might be going after the same businesses and that Cantor can direct opportunities to other entities if they see fit. This is a classic SPAC move, but it's worth noting the clear potential for competition and divided loyalties. They plan to list on Nasdaq under the ticker CEPV. That's the typical plan for most SPACs hoping to gain credibility and access to capital markets. They are also taking advantage of being an emerging growth company and a smaller reporting company. This means less public scrutiny and fewer disclosure requirements. While this saves them money now, it also means less transparency for investors and makes direct comparisons to other public companies tricky. To wrap things up, Cantor Equity Partners V is a SPAC backed by Cantor Fitzgerald, aiming to find a business to merge with. The deal structure, particularly the founder shares purchased at a nominal price, points to a significant risk of dilution for public investors and a strong incentive for the sponsor to complete a deal rather than necessarily the best deal. Their financial tables show minimal activity beyond setup cost, which is typical for a SPAC pre-combination. The key takeaway is that while Cantor has a robust financial services background, this SPAC structure, coupled with the founder share terms, makes it a high-risk, high-reward proposition for investors. You're essentially betting on their ability to find a diamond in the rough and navigate the complex SP landscape, all while managing potential conflicts of interest inherited from their sponsor. So what do you guys think about this structure? Are you bullish or bearish on Cantor Equity Partners V? Let me know in the comments below. If you found this breakdown useful, give this video a like and subscribe for more no-nonsense corporate analysis. And hey, join our Discord community linked in the description to continue this conversation and get even more real-time insights. Thanks for watching, and I'll see you in the next one.